A lot of countries apply an exit tax when you are leaving their tax system, becoming a non-resident for tax purposes and going to live in a new country. Australia is no different. So in this video, I'm going to talk to you about some of the things that you should be talking about from an Australian perspective, but you'll be able to loosely apply this kind of thinking to any country that has an exit tax system, because here we're not going to be getting into specifics so much, but just some of the main things that you need to be considering when you are planning your tax exit. If you do want to get into the specifics for your personal situation, we do provide consulting. We've also got a product up on our website, How to Exit the Australian Tax System. It's basically a blueprint of all the things you need to do, all the planning you need to put in place before and after you make your exit. So if you're interested in that, you can head over to offshoreandasia.com/shop, or you can also navigate to the menu at the top of the screen and click on the products button on the menu there, and that will take you there to it. So in this video, we'll discuss some of the main things that you need to be considering when you are planning an exit from the Australian tax system, and also how you can optimize your tax on the other side, because that's where the really good stuff starts to happen, or the optimization or the real opportunity to optimize on taxation. It comes on the other side after you make your tax exit. So we'll talk a little bit about that as well. So first up, what is an exit tax? Well, basically it is just a capital gains tax event. You can think of it like when you become a non-resident, so you leave Australia, you leave the tax system, you go to live in Thailand or Malaysia, it could be anywhere, but you've gone to live in a different country and you have become a resident for tax purposes in that country. That's very important as well. The ATO will treat certain assets as if you had disposed of those assets, you had sold those assets on the day that you became a non-resident in Australia, even if you did not sell those assets. So it's basically an on-paper calculation, a capital gains tax event, similar to if you had sold the shares or whatever it may be, even if you did not sell the asset. So they're going to take a bite out of your gains, and these will be unrealized gains on the way out, regardless of whether you have sold them or not. So then some of the things that you need to be paying attention to when it comes to paying exit tax is, depending on the asset type, there may be a deferral option. Now, the deferral doesn't apply, or the exit tax in general doesn't apply to taxable Australian property, but for other assets, there can be a deferral option. This might sound good in that you don't pay an exit tax now that you pay later on, but generally deferring a gain, and then if you go on to make a big gain later on, you can end up a lot worse because you lose a lot of the exemptions, such as the 50% CGT discount in Australia. You're going to be worse off later on. So most of the time, it depends, your situation and what the asset goes on to do, whether it makes a gain or a loss or so on. But generally, I would just say be careful if you're thinking of deferring your exit tax, because you could end up worse off. For a lot of people, it would be better to just take the haircut on the way out, cut and run, and then you're free from the tax system thereon. But you need to weigh these things up. Then one of the first things you're going to want to be doing is reviewing the double taxation agreement between the country you have left and the country you've moved to. So if you have left Australia and you have moved to Malaysia, you want to look at the Malaysia-Australia DTA. That's going to have a set of rules not only around residency but also around taxation. Certain types of income and capital, for that matter, are taxed in different ways depending on the tax treaty between the two countries. So you want to have a bit of an idea of where you stand with that, and then you can use that as part of your tax planning. Tax treaties are notoriously difficult to make sense of. It's the kind of thing you got to sit down and spend hours on just reading through it really slowly, and then you sort of have to have a bit of knowledge around taxation and how it works as well. If you're not comfortable with that, head over and book a consult call with us. We can assist you with it. Other things you want to take into consideration are, do you own property? Property is taxed very differently for non-residents as it is to residents. A lot of people choose to sell property. Some people choose to hold on to it. That's a personal and a financial decision. Now, is this property a primary residence or is it a rental property? Because again, that's going to change things on how the taxation is applied to you being a non-resident. So like I just said, a lot of people will decide to sell up and go. That's fine. That often might be the better way financially and taxation wise. Some people like to hold their assets in Australia. If you're thinking of just going over for a few years, leaving for a few years and coming back, and you think, oh, hang on, this property might be, I might be able to do something with it in the future and I don't want to give it up. Or maybe I'm thinking, house prices are going up at a pretty steady rate in Australia. I don't want to come back in 5 years' time and find that I'm priced out of the market. For reasons like this, some people will choose to hold their property in Australia, even though it often comes with an increased tax liability to do so. So it comes at a cost, but you're buying something with that. Everyone has a different view on this. Some people like to keep rental properties in Australia knowing that they're going to be paying 30% tax from the first dollar on rental income, knowing that they're going to lose certain exemptions and things for capital gains tax, but also knowing that that rental income in Australia, even at 70 cents in the dollar after you take out your 30% tax, is going to go a long way overseas. They see earning Australian dollars, or might be, US dollars or British pounds, earning a strong currency in a Western country can go a long way in Southeast Asia, for example. So some people will be happy to hold on to it, knowing they're going to pay more tax, but knowing that this money is going to help them to live a very good lifestyle in a different country. We can help you work through all of the calculations, all of the things you need to take into account with capital gains, with income tax, and then, working out the best way for you, because money isn't everything. Cash flow is very important. Cash flow is what funds your lifestyle. You're not going to get out of Australia scot-free, but you still can use Australia to your advantage even if you're not working there. So these are things that you need to consider. Then you're going to look at what other kinds of assets or investments you have. If you have shares, for example, if you have cryptocurrency, for example, these things will have an exit tax that applies to them. So you might have to sell a parcel of shares to pay for your income tax, for your exit tax. And that could be an opportunity to take some gains, cash out some gains, pay your tax, and then move forward and then hope for more gains on the other side. So whether you sell the asset to pay for the tax or you have some cash on hand to pay for the tax, that doesn't matter. You just have to have some liquid assets or some assets that can be liquidated into cash to pay the tax office your exit tax when you leave. You're going to look at whether you have any carried forward losses. That can be offset, loss-making assets that can be sold at a loss to offset against other gains to reduce your capital gains exit tax bill. And you may also be looking at losses in other structures that you have, companies, trusts, for example, that can be offset against each other, moving things around to lower your overall tax bill on the way out. All right, so you've made your exit, and I'm just very much summarizing this. There's a lot of stuff you should look at before you make your exit yourself. In this exit plan, this product that we've got up on our website, How to Exit the Australian Tax System, we go through it in detail. We have a pre-departure checklist. We have a post-departure checklist. We go through all the different aspects you need to think about. It's quite a large document. It's going to, I think, help you a lot to be able to do it yourself if you want to do it yourself, or at least increase your understanding of how it all works so you can talk better to your accountant and make sure they understand everything that's going on from your perspective. There is a lot of different information available online, and now we've got the chatbots and everything with AI and so forth. This stuff can be helpful. There's no doubting that, but I would just say, especially if you have a lot at play here, if you're looking at sort of, potentially big exit tax bills, if you have a lot of assets in Australia, I wouldn't be trusting a chatbot to tell me what to do. It's okay to use it for your research, but definitely talk to an accountant who is familiar with expat tax matters before you make any concrete moves. It's not the kind of thing you want to be trusting to a chatbot or cutting corners on in general. Of course, the more money you have at risk, at play here, then the more careful you need to be and take your time with it accordingly. So you've made your exit. On the other side, you need to again review the DTA, the tax treaty for assets with beneficial tax treatment, assets and income in general, because different types of income, business income, dividends, interest, personal services income, government bonds and so forth. This is often pensions. This stuff is all treated differently in the tax treaty between the two countries, and they will have specific sections in the treaty dealing with these particular asset and income classes. So when you have a good idea about which kind of income will be tax optimized per the tax treaty, you can sort of lean into that a bit more. So you can use that as part of your tax planning. You also need to have a very good idea about the tax rules in the country you are moving to. You're going to now be a resident of this country. If you've moved to Thailand, if you've moved to Malaysia, wherever you have moved to, if you're a tax resident there, you need to understand how the tax rules there work. So that will often involve hiring an accountant in this new country. Again, an accountant who understands expat matters and working with treaties across international jurisdictions and so forth. And we are available to provide that service for you if you wish. Feel free to get in touch at offshoreinasia.com. But you need to understand how things work on both sides of the coin. The Australia side, the Thailand side, if that's where you've come from and where you're going to, the tax treaty that interacts between those two countries. You need to know where it all stands. And then you can plan around it, because some countries tax based on remittance. Some countries don't tax foreign sourced income provided you don't remit it. Some countries don't tax dividends. Some countries don't tax capital gains. That is correct. Some countries do not have a capital gains tax. Australia never used to have a capital gains tax back in the day, and some countries still don't regard capital gains as taxable income. So that can be very beneficial for you if you have assets that do grow over time. And some countries won't tax undistributed profits from a company structure. So that's another thing. If you have a company, then depending on where you are incorporated, you're going to need to look at the tax treaty between the country where you are incorporated and the country where you are living. So it can get quite complex, guys. You can be working across sort of 3 different jurisdictions, 4 different jurisdictions, depending on where your companies are, where your investments are, where you've come from, and where you are living now. There is quite a lot of moving parts to it. And once you understand all these moving parts and how they interact, that's how you can put a plan together to capitalize now on being a non-resident from Australia and a resident in the country where you now live. You can structure your investments in a way, put your, where you set up your companies, where you set up your investments, how you move that money around. If you're smart about it and have a plan, you can minimize your tax by quite a lot if it is done the right way. And it's not just about the tax savings that you get today. That's fantastic, but you're also generally going to get cost of living savings if you're living in Southeast Asia. I live in Thailand, for example, and it probably costs me about a quarter to a third of what it would cost me to live the same lifestyle in Australia. So you're going to have big cost of living savings, you're going to have big taxation savings potentially. And then the thing is, what do you do with that? Are you investing in a jurisdiction that has low taxation? Is that investment income then tax optimized? So each year you've got more money in your pocket, more money you can invest. You can upgrade your lifestyle if you want, but you can absolutely buy more assets and improve your life in the longer term. Over a period of time, having this extra money every year that is taxed less, having lower living costs every year, investing this extra money every year in a tax optimized way over a period of 4, 5, 6 years and even more, it can turn into a lot of money. So making the move and setting yourself up properly can be a big financial windfall for you. It's not unusual for people who are doing this, making normal money. They could come over to Southeast Asia in a tax optimized country and set up in a tax optimized way, and they might live here for 5 years or 10 years or whatever. They could go back to Australia with an extra $500,000 or $1 million in their pocket. Like, this stuff is real, it does happen. And then you can go back and then buy the house that you want that you can't afford now, or whatever you want to spend your money on. There is massive opportunity there for people who want to take a bit of a longer view and set themselves up correctly from day one. So if you're interested in exiting the Australian tax system, again, you can head over to our website, offshoreinAsia.com, click on the products menu there. You will find the blueprint for making the exit from Australia, becoming a non-resident for tax purposes, and how to do it correctly so that you get out clean, so that you minimize costs, and so that you don't have issues with the tax office moving forward. If you want to do some one-on-one consulting, you can go to our website and click on book a call in the top right, and we offer consulting there as well to help you work through your specific scenario. Thanks for watching. I hope this gave you a better idea of some of the things you need to think about. This stuff is important, and if it's done well, if it's done right, it can be very beneficial to you from a financial standpoint. The more over a period of time that it goes, the bigger the benefits are. Thanks for watching, guys. We'll see you later.